So if you own gold, if you're even thinking about buying it, or maybe your family invests in it, you're going to want to hear this because lately, gold has been acting, well, incredibly strange. Just a little while ago, it did something we haven't seen in over 40 years, and it's left a lot of people asking, is gold still a safe bet?
And that's really the big question, isn't it? Is gold still something you should be buying? Or, if you're one of the people who bought at the recent peak, should you sell? Well, it's not quite that simple. For most of us, gold is supposed to be the ultimate safe haven. You buy it and your wealth is protected, right? But its recent behavior has really put that whole idea to the test.
Okay, let's just break down what actually happened. As gold's price was soaring, a technical indicator called the RSI, which basically tells you how overbought something is, spiked above 90. Now, to put that in perspective, that signaled the most extreme, insane buying saturation in the last 40 years. It was pure euphoria. Everybody had FOMO, convinced they had to get into gold right then and there.
And then, just after hitting that massive peak, something happened that you almost never, ever see with gold. It crashed. A drop of nearly 10%. It started acting more like a volatile tech stock than a stable asset. This was the single worst crash for gold in 43 years. I mean, for most of our lifetimes, gold has never, ever behaved like this.
So this right here, this is the mystery we need to solve. Analysts have been warning that a price spike like this isn't just a number on a screen. It's a signal that something massive could be about to break in the global economy. The level of fear is apparently even more extreme than what we saw back in 2008 or 2020. So before you make a move, let's figure out what on earth is actually going on.
And look, I totally get it. The pressure to buy was intense. I'll be honest, even some of my own team members bought gold right at the top. And why? Because they got completely swept up in the FOMO without really understanding the story behind this crazy price action. The vast majority of people who bought in were just following the crowd.
To make sense of all this chaos, I'm going to give you a really simple framework. I want you to think of gold's price as a three-legged stool. See, unlike a stock, gold has no cash flow. It pays no dividends. There's no business behind it. Its price is moved by three huge forces, and if you can understand them, you'll know if it can still protect your wealth.
So these are the three pillars, the three legs of our stool: fear, the strength of the US dollar, and this thing called real yield. When these three are in balance, gold is stable. But right now, well, they're basically at war with each other.
All right, let's dive into that first pillar, which is probably the one most people are familiar with: fear. You know, the logic here is pretty straightforward. When the world feels chaotic, you've got wars, pandemics, political turmoil, people start to question the value of the paper money in their wallets or the numbers on their bank screen. They start asking, is my money really safe? And that fear, that drives this big migration of wealth into tangible things you can touch, and gold is almost always the #1 destination. Now, some of you might be thinking, hang on, what about the 2008 financial crisis or COVID? Those were super scary times too. And you're right. But the difference is, back then, there was always a rescuer we could look to. In 2008, it was the governments bailing out the banks. In 2020, it was the hope of a vaccine. The problem now is that the very entity that's supposed to be the rescuer, the state itself, especially the US with its massive debt, is the source of the instability. And that's a whole new level of fear.
Okay, so now let's look at the other two legs of the stool. These are a little more technical, but they are absolutely crucial because right now they're fighting directly against that fear pillar we just talked about. We're talking about the US dollar and real yield.
First up, the US dollar. The global price of gold is always quoted in US dollars, so it's pretty simple. When the dollar gets stronger, it just takes fewer of those dollars to buy an ounce of gold. But for every other country in the world, that means gold just got more expensive in their local currency, which can push demand down and pull the price down with it. They basically move in opposite directions.
All right, the third pillar is something called real yield. It sounds complicated, but it's not. It's just the return you get on a super safe government bond after you subtract the rate of inflation. So, for example, if a bond pays you 5% interest, but inflation is chewing away 2% of your money's value, your real yield is 3%.
So why on earth does this matter for gold? Well, think about it. Gold pays you nothing to hold it. No interest, no dividends, nothing. So if you can get a high, guaranteed return from a US government bond that's also adjusted for inflation, why would you hold zero-yield gold?
The data shows this relationship is incredibly powerful. For every 1% that real yields go up, the price of gold tends to fall by about 4.7%.
Which, of course, brings us right back to our big question. If that fear pillar is stronger than ever, with all the geopolitical chaos happening, why in the world did gold suddenly crash by almost 10%?
And this is where you can see the conflict perfectly. The three pillars are at war. That crash happened because the dollar and real yield pillars suddenly kicked back with incredible force. There were rumors swirling about a potential nominee for the head of the U.S. central bank, a guy named Kevin Warsh, who is famously hawkish. That's just a fancy word for someone who's really tough on inflation and loves higher interest rates. So the market instantly priced in a stronger dollar and higher real yields. And for a moment, that short-term economic logic completely overpowered all the geopolitical fear.
So, what does all this mean for you as an investor? Well, this recent volatility shows that trying to time the gold market is a really dangerous game. The key here, the most important thing, is to fundamentally shift how you think about gold's role in your portfolio.
You know, the whole reason gold is called a safe haven is for this exact purpose. Its job is to protect your wealth over the long haul, not to make you rich overnight. If you're looking for explosive short-term gains, you're honestly just using the wrong tool for the job. This is the mindset shift we're talking about. The trader's mindset asks, when should I buy so I can sell for a profit in 6 months? That's the kind of thinking that leads to buying at the top during a FOMO frenzy. But the new mindset, the insurer's mindset, asks, how can I add a layer of long-term insurance to my entire portfolio to protect against major risk? It's a completely different ballgame.
Okay, so let's make this really actionable. First, just stop trying to trade gold in the short term. This wild ride we just saw is an anomaly. Second, view gold as a long-term holding. I'm talking 5, 10 years, or even more. Look, even central banks around the world are buying gold, not for a quick buck, but as a long-term reserve asset. And here's a simple, practical rule. As a general principle, try to avoid buying any asset when its RSI is above 90. It's just a crystal clear signal that you're likely buying into a frenzy.
Look, at the end of the day, the world is not okay right now. The deep-seated fear that drove gold to record highs, well, it hasn't disappeared. It was just temporarily overshadowed by those other two pillars. That first and most powerful pillar supporting gold, systemic fear, is still incredibly strong. So the real question you should be asking yourself is this: in a world full of so much uncertainty, does your portfolio have its insurance policy?